Howdy and welcome back. This is the weekly wrap-up for Friday, June 18th, 2021. I hope everyone's had a terrific week. It's been a little toasty here in the mountains of Colorado. Had temperatures pushing up in the high 90s most of the week, and kind of miserable when you live in a house without air conditioning. So the upstairs was quite toasty most of the week. So down here in my office, it's always a comfortable 70 degrees, but anyways, well, the heat wave broke finally, and today's high is only about 79 degrees, which, whew, thank goodness. So good news for, I guess, people in the Midwest. The cooler weather is coming your way, so you hopefully won't turn into bacon before the cool weather gets to wherever you're at. So interesting week in the world. So markets have been kind of crazy, and so let's go ahead and jump into the markets and take a look and see how they did this week. No one cares about that. All right, the Dow Jones. Let's get over here and look at the 1 week chart. All right, Dow Jones was down about 3.39%. Was pretty flat, the first half of the week, and then when the Fed came out and was talking about the potential for a rate hike in 2023, it's caused a little bit of consternation in the markets. The S&P 500, let's see how badly it did, down 1.81 for the week. NASDAQ actually did pretty well, or comparatively. Looks like it was up 0.46, so about 0.5%. The Dow Utilities down 2.97, and the Dow Transports, let's take a look here, and down 4.5%. So all in all, not the best week. Like I said, I would venture an educated guess that the actions from or not even actions, just the statements from the Fed led to the market tumbling a little bit this week. So, all right, let's get on to, let's see if there's the news, the financial news of this week. Dow posted its worst week since October. Let's see, all three main U.S. indexes lost ground on Friday. Yeah, we just talked about that. So, let's see, October, yeah, that was a pretty big, decent drop there too. So let's see what other news there was. The dollar had its best week in quite a while. So I know I've talked quite a bit about the dollar index over the last year, something to keep an eye on. So you might ask, well, why is the dollar index improving when the markets are, kind of going to hell this week? Well, it's all about supply and demand. If people are selling their stocks and bonds and moving to cash, that's going to put upward pressure on the dollar. So I mean, everything is a commodity in a sales transaction. So and then the opposite. When people were jumping into stocks over the last year, we've seen the dollar index go down quite a bit. Even got down into the high 80s for some short bits over the past couple months. So, like I said, pay attention to it. When the dollar index starts to crash, when stocks are doing poorly, that would be a sign, in my opinion, that not only are the markets in trouble or in some flux, but the dollar might also be having some issues at that point too. Anything else? Commodities prices tumble. I know gold and silver dropped pretty dramatically this week. I'm not sure about oil. So, alrighty, well, let's go ahead and take a look at the numbers for employment. They should have done. I know they were off a little bit, but I don't think that they were terrible by any stretch. So let's take I usually have this up and ready before I get started, and I forgot to do it. All right, this week, let's go to Thursday. Initial jobless claims came in at 412,000. Forecast was 459,000. Let's see if last week's number was actually revised down by 1,000. Nothing huge. And this week's forecast was off by what, about 50,000 human beings. So, I mean, the numbers are going down. So, you know, I know I typically am kind of a sourpuss about, you know, I'm like Eeyore when I'm looking at a lot of these charts and trends. But I mean, we are making progress. So, you know, from February where we had 700,000 people filing for unemployment, we're down to the, you know, high 300s, low 400s. So again, let's look for the silver lining. Alrighty, and then continuing jobless claims, they came in at 3,518,000 against a forecast of 3,430,000, so not too far off. Let's see, last week's numbers were revised up a smidge from 3.499 up to 3.517, so again, negligible. And again, let's look at the longer term trend. Going back, you know, to February, we were at like 4.5 million. Now we're down to 3.5 million of continuing claims. So again, 1 million people back to work. You know, that's positive news. Now, if the government would quit paying people to sit on their asses, that would be a much better thing. Alrighty. This is an article that came out from First Trust this week, written by Brian Westbury. You know, Brian's one of my favorite economists, smart guys out there, and what he's talking about here in he titled it "Fed Hawks Hatch," and what he brings up here is that you know, the last year or so, the Fed has said we're not raising rates, we're leaving them at or near zero, and evidently just since March. 7 policymakers at the Fed are now in favor of a rate hike, versus back in March it was only 4. So, I mean, granted they are still in the minority, but you know, that is progress. That, you know, the powers that be that run the Federal Reserve are starting to come to their senses that this is you know, unsustainable at this point. Also, Chairman Powell stated that the Fed will continue their purchases and adding to their balance sheet of $120 billion a month of treasuries and mortgage securities, but also that they're going to try and give as much advance notice as possible that, you know, when they will start tapering again. And you know, in his opinion, you know, it would be sometime this fall that they would start giving some of that guidance, and with tapering to begin sometime in 2022 or the beginning of 2022, maybe sooner. All right, and just talks about the possibility of a rate hike. Let's see. Like I said, I'll attach a link so you can go ahead and read this if you want. You know, First Trust puts out fantastic deliverables as far as you know, market analysis. I mean, they do amazing work. So they're some of my favorite. I mean, granted, they do sell investment products. That is you know, a big part of their job. But their research team and staff. I mean, if you're going to read some, you know, I mean, like when you read Fidelity or, you know, any of these big firms that sell financial products, you kind of have to wonder, you know, is this, you know, like an ad you see in the, I don't even know what magazines are out anymore, People magazine, where it looks like an article, but it's really an advertisement. These guys actually go deep down into the, you know, into the subjects and you know, provide you some really good information and data. So, all right, I had a couple of podcasts that I've listened to over the last that I thought would be good to share with everyone out there. The first one is called "Regulation Would Not Have Saved Us in 2008." and this is from the Tom Woods Show. And what he's talking about is, you'll hear folks out there that say, well, if we hadn't deregulated, we wouldn't have had the financial crisis back, in 2008 and 9. So Tom goes into some details on this, and I'm just going to play a short clip, but I would encourage anyone out there to go ahead and give this a listen. So let's go ahead and start with.
Hey everybody, Tom Woods here. All right, now today we're going to get into the details that I have not covered very much in the nearly 2,000 episodes of the Tom Woods Show, maybe a little bit here and there. But what I want to do today is address specifically the claim that deregulation is what caused the financial crisis of 2008. And I want to go into the specifics of what that claim amounts to. Now, most people who make this claim honestly have no idea what they're talking about. If you were to say to them, name me a repealed regulation that would have prevented this crisis, they have absolutely no idea what to say. The more advanced ones might say something about the repeal of Glass-Steagall, quote unquote. And what they mean to say is the partial repeal of Glass-Steagall, and we'll talk about that. But in general, most people don't even know an answer. And if they do have an answer, their knowledge is, sometimes people say a mile wide and an inch deep. This is like an inch wide and an inch deep. If you were to follow up with them, they really have nothing to say. So I want to arm you with the ammunition you would need in case you find yourself in this discussion, but also just to make clear how misleading, to put it mildly, the conventional wisdom about this is. And it goes to show why it's so important to smash this kind of conventional wisdom before it ossifies. In yesterday's episode, number 1907, I set the stage a bit by describing the ways in which the federal government and the Federal Reserve stimulated housing artificially and the problems that resulted from that. And so now we're going to go on to this other dimension of the question. But I want to just say that it's naive and uncomprehending to think that once the Federal Reserve has set an artificial boom in motion, that there's some kind of phantom regulation that can reel it back in. At that point, the horse has left the stable. It's a little bit ridiculous once you've allowed the Federal Reserve. If you don't want a financial bubble, then get rid of the Federal Reserve. Get rid of the credit spigot that allows these bubbles to be blown up and to persist. But don't let that happen. Don't let the Fed engage in crazy money creation and then ignore that and sit back and say, if only we'd had more regulation. That's so beside the point. One of the best forms of so-called regulation from a free market standpoint is to let failing businesses fail when they need to fail. And so what I want to start with is the claim that, well, we can't do that because some institutions are too big to fail. So we can't let them fail because then there'll be a cascading of failures throughout the economy. We don't want that. So we can't actually do.
All right, I'll go ahead and stop that there. Kind of a cliffhanger on why that's important. So, like I said, I'd give that a listen. It's only about how long is it? About 42 minutes. I listen to it at 1.5 speed, so I can get through his shows fairly quickly. So if you do listen to it on just like normal speed, he will sound a little bit different than what I play for you guys. So, all right, and then the next one is also from Tom Woods. If you haven't noticed, he is someone that I do listen to pretty much daily, and one of the smartest guys I don't know him personally, but one of the smartest people I study and anyways. So the second one is called the episode 1910, the Bullish Case for Bitcoin, and his guest is Vijay Boyapati, and I apologize, Vijay, if I've butchered your name, not that you'll ever probably see this. So he's talking about how the advantages of Bitcoin, and answers some questions that I know. One that the segment I'm going to play here is talking about the amount of energy that's consumed in Bitcoin transactions and creating blocks, and the energy created to create a new coin. So I know Elizabeth Warren, the brilliant senator from Massachusetts, that's dripping with sarcasm if you did pick that up, stated the other day that one single transaction used up more energy than, I think she said, an entire city, or it was something ridiculous. And Vijay gets into what the what energy is used to produce Bitcoin. A lot of it comes from excess energy. Like in China, they have a lot of hydroelectric that has surplus energy, and in those places, Bitcoin miners will use energy in those cases. There's another instance where I heard that folks were using, like in refineries, how you have excess fumes and gas that are usually burned off, and using the excess or waste, they're using that as the fuel to to create the electricity for Bitcoin. So in a lot of ways, they're using excess energy that would be wasted or lost to actually create a commodity. So it is definitely you're not getting the full story, unfortunately, when the brilliant Elizabeth Warren speaks. So let's go ahead and listen to VJ speak here for a few minutes, and I'll come back and we'll wrap things up.
I completely agree with you on that sense. We need to look at the utility of money. But Elon Musk's concern is about the consumption of electricity. And again, as people who are...
Let me pause that and slow this down for you. He talks a little quick.
Very liberty-minded and believe in Austrian economics, I think our first response would be, well, the consumption of energy goes hand in hand with the flourishing of human civilization. We humans use very little energy when we were hunter-gatherers, but do we want to live in a sort of state of existence where we live hand to mouth and could be ravaged by an animal, or if we get sick we might die? We don't want to live in that state of nature. So the increasing consumption of energy is actually a reflection of the development of civilization. I think it's a very positive thing. But to give the strongest argument, I think it's always important to try and steelman the arguments of your intellectual adversaries rather than strawman them. And I think if I was going to give the steelman argument for what Elon Musk is saying is, Bitcoin consumes all this energy, and we're concerned about the world because if enough greenhouse gases are emitted, then we could get into a tailspin where the global climate gets out of control, and then the Earth isn't a habitable place for any of us. Now, I personally don't believe that's true, but let's just sort of take that on its face value and say that's the concern that they're coming with. So that kind of concern, I would say, you really need to look at the energy distribution, the energy consumed by Bitcoin, and what is the mix of energy? Is it consuming a lot of fossil fuels and emitting a lot of greenhouse gases? And actually, if you look at the consumption of Bitcoin energy by Bitcoin miners, the dominant case is that it goes towards places with renewable and excess power production. And a classic example of this is the Sichuan province in China, where they massively overbuilt hydroelectric dams, and they have all of this cheap electricity because the population in the particular area isn't large enough to consume all the electricity that was built. Now, this is an example of governments being very bad at managing an economy. They have massive overcapacity in one area and undercapacity in another. But it just happens to be that there's a lot of overcapacity of hydroelectric energy in the Sichuan province. This is somewhere that Bitcoin miners love to go, and it's one of the largest centers of Bitcoin mining on Earth, because Bitcoin miners, their primary input cost is electricity. So they're looking for places where electricity is essentially being thrown away. And why is it thrown away? It's thrown away because electricity is not really a fungible commodity. Electricity made in Sichuan province the excess can't be transported to Texas and used for something else. There is a very rapid decay of energy over distance. So you can't transport it very far. So the energy that's produced, the excess energy that's produced in Sichuan province was essentially just thrown away. So Bitcoin miners go there and they think, wow, this is really cheap. You're not even using this electricity. We're going to run our computers here because this is our primary input cost. So the carbon footprint of Bitcoin mining is actually very, very low, because the big centers of Bitcoin mining are places like Sichuan province, Wenatchee, which is near where I live in Seattle, where they have a big hydroelectric dam, and places like Iceland, which have a lot of geothermal energy. These are all places where Bitcoin mining tends to concentrate because miners are looking for that excess energy. And one of the coolest things about Bitcoin mining is that Bitcoin is this digital good that you can sort of transmit over the internet, which means you can do Bitcoin mining anywhere. All you need is power and an internet connection. And if you really believe in renewables, if you think that's important, you should actually be behind Bitcoin and support it, because it incentivizes the creation, the production of energy in places where renewable energies are available, but there may not necessarily be a big enough population to economically support it. So you can go to places like that and build a big Bitcoin mine and then make money off the development of renewables in that area, and perhaps ultimately...
Go ahead and stop that there. So definitely some good information, some food for thought. I always like to try and present the counter side of the argument so that everyone has the full story, as opposed to the bullshit that you might get from CNN. I'm not sure who actually watches that anymore. But anyways, so all right. Well, that's everything that I had from a news perspective and what's been going on in the world. We'll see where the markets open up on Monday. Let's hope for some more stability. But like I said, the volatility we saw here at the end of the week, is it more of traders, exiting their long positions in the stock market and thinking that, well, this is with the Fed potentially tapering their purchases and potentially of a rate hike again 2 years from now. To me, it seems more like people are just a little skittish and maybe just taking some money off the table. But we'll see where the longer term trend goes and go from there. So hope everyone has a fantastic weekend. And if you need anything, be sure to reach out to me. Also, like, subscribe, and share with your friends. And have a great weekend. Bye-bye.